Listen, the stock markets tried to come back a bit, and depending on which index, there was definitely some success there considering some of the earlier levels, but it certainly doesn't seem to have held. And equilibrium is a tough thing to get, especially when the feedback loop emanates from the interest rate side. And of course, stocks and the foreign exchange markets all contribute. I made a list of things to pay attention to. Obviously, all of this emanates from China and trade talks and the global effects and the supply chains and all the inherent structures and the intersections. But, you know, many believe that the president's goal is a good one. Okay, we need to address China and we need to think about the long term. The problem is that along with that package, we get a lot of things we really don't want. And truly, the president, with regard to what he thinks he wants with regard to interest rates or the foreign exchange markets, I don't really think that he's going to get what he wants, which means better left unsaid. Concentrate on this, because what it's doing is it's adding into all the issues we have to deal with. Negative rates is top of the list. You know, I think the last estimate's 15 trillion, but it doesn't really matter. The fact of the matter is it's growing, global growth is slowing, and the race to the bottom is going to make that number bigger. And if you don't believe me how this all turns out, because it certainly seems though many central banks, including ours, are just blinded to the examples all around them, just look at some of the banking indexes and what they're trading and how many decade lows they are outside the U.S. Another thing, of course, is supply. Nobody's talking about it. Remember when supply and debt didn't matter? New monetary policy. Well, it's starting to matter. Why? Because the new budget deal is triggering what I call fill the fountain with water. They're trying to fill it up because they were running pretty close. Remember when they said money would run out? Which means we're going to be getting a boatload of T-bills and a boatload of treasuries. Well, why would that make a difference? Because all of this is happening so fast at a time where stability in the dollar is waning. Dollar funding's a huge issue, and until that settles down, nothing's going to settle down. The TY VIX today for a while was at 649. If it would have closed there, that would have been the highest volatility since Dece of 2016. Finally, keep a very close eye on 30-year bonds. Now, quickly, I'm going to show you why 30-year bonds, if you look at 2016, they had a 2.099 low, all-time low. We're about plus 5 basis points away. You really want to watch that as a trigger for more to come. 10-year note yields, also in 2016, had the second leg of a two-leg double bottom just above 135. If this goes, most likely this is going to join it quickly. Finally, the dollar index. You know, this chart starts in early 17. Several days ago, we were at the highest level since May of 2017. We haven't given back much. That is your tell. Dollar funding's a huge issue, the race to the bottom, but in the end, if the president really thinks he wants a lower dollar and lower rates, maybe Larry Kudlow ought to put him in a room somewhere and tell him what's really happening.